When you're trying to figure out if a company is actually doing well, it's so easy to get lost in all the numbers. But what if I told you there's one key metric that just cuts right through all that noise? It's called return on equity, and we're about to break down why it's pretty much an investor's secret weapon. And hey, this isn't just my opinion. We're talking about legends here. Think Warren Buffett. He and a lot of other top investors see a return on equity, or ROE for short, as one of the absolute most important vital signs of a healthy, well-run business. It's that crucial.
So you got to ask, right? What's their secret? How do these folks find winning companies time after time? Well, a huge part of the answer lies in mastering this one single ratio. Understanding ROE is like getting the key to making way, way smarter investment choices. So here's what we're going to cover. First, what exactly is return on equity? Then we'll get into the super simple formula. We'll even run through an example so you can see it in action. And you'll want to stick around because we're also going to talk about something called the high ROE trap. Finally, we'll pull it all together.
All right, let's get right into it. What is return on equity? Well, the best way to think about it is to put yourself in the shoes of an owner. Imagine you own the company. ROE is basically your report card. It tells you exactly how good the management team is at using your money to make a profit. The official definition is right there. It's a ratio that measures the profit a company makes with the money shareholders have put in. It creates a direct link, right, between the final profit, the bottom line, and the actual cash the owners have on the line. Okay, let's break that down even further. Forget all the jargon for a second. ROE answers one super simple but incredibly important question. For every single dollar the owners have put into this business, how much profit did the company spit out? Simple as that.
Now, I know what you might be thinking. Oh, great, here comes the math. But trust me on this. This is way easier than you think. The formula is actually really straightforward. Let's take a look at how to calculate it, and just as important, where you can find these numbers.
It's literally just a few easy steps. Step 1, you grab the company's net income. You'll find this on the income statement. Step 2, you find the shareholders' equity, which is on the balance sheet. Step 3, you just divide that first number by the second. And finally, step 4, multiply that result by 100 to get a nice clean percentage. See? Not so bad at all. Okay, so theory is one thing, but seeing it in action is where it really clicks. So let's do just that. We're going to run the numbers for a made-up company. We'll call it Company A and see what we find. All right, let's meet Company A. Like pretty much every business out there, it needed some cash to get off the ground. And it raised that money from 2 different places. So, in total, they got 100 crore to work with. But this is the important part. Where did it come from? 40 crore of it came from the owners themselves. That's our shareholders' equity. The other 60 crore, that was a loan from the bank. That's debt. And believe me, this difference between owners' money and borrowed money is everything. So, Company A goes about its business for a year. They pay all their expenses, the interest on that loan, and of course their taxes. And after all that is said and done, they're left with a net profit of 8 crore. Now this is the money that truly belongs to the owners. Okay, time to plug and chug. Let's pull out our formula. We've got our net income, which is 8 crore, and we've got our shareholders' equity, which is 40 crore. So we're just going to divide 8 by 40 and then multiply by 100 to make it a percentage. And bam, the answer is 20%. This number is so powerful. It tells us that for every 100 rupees the owners put into Company A, the company generated 20 rupees of pure profit. That's a 20% return on the owner's capital. Not bad at all. Okay, so simple logic, right? A higher ROE has got to be better. The higher the number, the better the company. Well, not so fast. This is where things get really interesting, and it's something every investor has to know. It's called the high ROE trap. And yeah, sometimes a fantastic-looking number can actually be a major warning sign. So let's bring in another company, Company B. Check this out. It made the exact same profit as Company A, 8 crore. But look at its setup. It has way less of its own money in the game, only 20 crore in equity. And because that equity number in our formula is so much smaller, its ROE comes out to a massive 40%. That's double Company A's. So, this brings us to the big question, doesn't it? Which one is the better investment? On paper, Company B looks like a superstar with its 40% ROE, crushing Company A's 20%. But is it really the better bet? You have to see that its amazing ROE is being pumped up by debt, and debt, my friends, always adds risk. And this is exactly why context is everything in investing. ROE is an incredible tool, for sure, but it's just one piece of a much bigger puzzle. If you're going to use it right, you absolutely have to look past that one number and see the whole picture of a company's financial health. So, what are the key things to remember here? First, and this is the big one, never ever use just one ratio by itself. It's just not a good idea. Second, ROE is great for comparing companies in the same industry. And third, you always have to look at the full picture, especially the debt. Because as we just saw, a super high ROE that's just being propped up by a mountain of debt, that can be a huge red flag. And that leaves us with one last, kind of mind-bending question to think about. We know Company A had a 20% return on equity, but if you go and buy a share of Company A today, does that mean you are going to get a 20% return on the money you just spent? The answer might actually surprise you, and it opens up a whole other level of what it means to be a smart investor.